While the Fed has said again and again that it does not want to experiment with negative rates, it might have no choice. Since last Friday, Fed fund futures have briefly traded above 100. For the first time ever, the market is discounting negative rates in the US. Coronavirus growth concerns aside, my biggest worry for several years now has been the value of the dollar. As I have said before, a high-value dollar is restrictive for global growth. Reason being, it makes it hard for EM countries and Eurodollar borrowers to service their debt. Fed swaps have to a certain extent help with funding needs. However, the currencies that have gained versus the dollar recently still have a long way to go from where they came from. Also, the euro has not gained versus the dollar at all. Please note that in the US, most corporations borrow from the bond market. When companies default, for the most part, it does not touch the banking system, as creditors swap debt for equity. However, in Europe, most debt comes from the banking system, and when defaults are on the rise, it is the banking system that takes the hit. A lower dollar will help both EM countries like Brazil and many corporations with dollar debt to avoid bankruptcy. Not all will survive the current pandemic, but unless the dollar falls in value, it will make matters worse. As such, the market needs the dollar to fall. And I think eventually the market will force the Fed to act. Back in November of 2018, Chairman Powell said he wanted to raise rates and shrink the Fed's balance sheet. The market then corrected about 20% and hinted at recession, and the Fed took everything back and then some. I think the same thing will happen with negative rates. And when we do see negative rates in the US, it might just be what will take down the dollar, especially versus the euro.